Well, let's get started. Welcome to this webinar about strategies for restaurant owners to survive in the new normal. Our topic, we expect, will lead to a robust discussion among our speakers, all of whom are very experienced in the restaurant industry, whether as advisors, strategists, or executives. We've got a variety of professions represented in our audience today, from the restaurant industry, finance, and consultants. Our program is directed toward restaurant owners and operators, as well as those who service the industry. During and after our discussion, we encourage you to submit your questions through the Q&A link. We'll do our best to respond to those questions after our discussion. As a formal housekeeping matter, the remarks of the speakers do not necessarily represent those of their firm or company. Let's get started and get to know our speakers. First, Denyelle Bruno, CEO and President of Tender Greens.
Good morning, everyone. I'm Denyelle Bruno, CEO of Tender Greens, which is a 50-unit restaurant chain based in Southern California. We serve farm to fork food at a very approachable price, and I'm very happy to be here.
Thank you, Denyelle. Next, Duane Stulich, Managing Director of Focal Point.
Hello, everyone. First of all, for those of you in the audience, if there are any that do know me, you may notice two changes about my physical appearance. One is my shaved head, and the other is from time to time I'm having to wear glasses. There's a story behind each. I call this the COVID cut. Been trimming my own hair for the last 3 months, and unfortunately everything had been good, and then I took out a divot over the weekend, so I decided to just take it off. But I'm with Focal Point. We started back in 2002. We really do three things. We raise capital, debt and equity, we sell businesses, and we work with distressed companies on restructuring either in and out of court. So restaurants has always been a big sector for us, and I'm excited to be on this panel.
Thank you, Duane. Next, Steve Horowitz, Steve Horowitz and Associates.
Thank you. I'm a former food service distributor and manufacturer. The company I ran was the 26th largest distributor in the United States and the 5th largest out of a single building. And the company was sold to a company, New York Stock Exchange company that eventually became US Foods. After helping to run that for 3.5 years, I started my present company, Stephen Horowitz and Associates, and we do consulting and mergers and acquisitions with food and food-related companies. And over the years we've had this business, we've done 98 projects for 38 manufacturers, 276 projects for 82 food distributors, 89 projects for 42 restaurant groups, and also projects with food importers, brokers, wine companies, restaurant design firms, and equipment companies.
Thank you, Steve.
That's my background.
Next is my partner, Brian Davidoff, who chairs the Greenberg Glusker Restructuring Group.
Thanks, Joel. Good morning, all. I'm Brian Davidoff. As Joel mentioned, I'm Joel's partner at Greenberg Glusker, and I'm a corporate restructuring attorney. I focus on companies in all manner of financial distress, whether that's out-of-court workouts, Chapter 11 reorganizations, Chapter 7 liquidations, assignment for benefit of creditors, some of which we'll talk about during this program. And over the course of the years, I've represented whether the companies, borrowers, lenders, buyers, sellers, vendors, all people involved in the various aspects of financial distress. And glad to be part of the program. Thanks, Joel.
Thank you, Brian. Well, I'm Joel Weinstein. I chair the Greenberg Glusker Restaurant, Food, and Beverage Group. My experience is in mergers and acquisitions and serving as outside general counsel for middle market companies. My specialty is in the restaurant industry, where I represent many different sectors, including quick service, fast casual, and fine dining, as well as celebrity chefs and producers of products used by restaurants. Let me set the stage for today's discussion. COVID-19 has dramatically impacted the restaurant industry. The numbers are staggering. It's expected the revenue loss for about $250 million in 2020. During March and April, at least 6 million employees lost their jobs, with about 1.5 million being rehired in May. And of course, much like a forest fire that clears out the brush, unfortunately, many restaurants have shuttered and are likely to close completely, with 20% of pre-COVID restaurants. Restaurants have been really impacted by the virus. They've been shut down. They've had layoffs and furloughs. Restaurants had to pivot in order to generate revenue from takeout, delivery, and in some cases as grocery pop-ups. If restaurants have had to deal with landlords, lenders, and employee challenges. Restaurants have sought life through the Paycheck protection loans, as well as emergency injury and disaster loans, trying to figure out whether the PPP loans were as good as they were advertised. Restaurants negotiated deferments and abatements with landlords and lenders. You know, French became the popular language, with the force majeure clause coming into play as to whether excusing late or no payments. Restaurants have been immersed in what could be described as both confusing and conflicting regulations from the CDC, the county, and the city about employee and safety health measures. Restaurants feel the pain of third-party delivery charges. Gradual restaurant openings in LA have been limited by caps in occupancy, and where owners daily have to address hygiene while maintaining hospitality. And then came the curfews. Those that have the capital and have survived these punches may see their way to seize opportunities for new restaurant locations, more decent rent levels, and even acquiring targets at lower multiples. So let's get started. Let's start with Denyelle Bruno, CEO and president of that wonderful Farm to Fork restaurant, Tender Greens. Denyelle, you've had to face all the challenges thrown at us by COVID-19. What are some recent innovations that have been adopted by Tender Greens to generate new sources of revenue?
Thanks, Joel. So, there's been a lot of changes over the course of the last, 4 months, really. And when the crisis first started, everyone will recall that one of the signatures of the crisis was that groceries became less available. Not only were they running out of inventory, but people often felt unsafe to actually go purchase at a grocery store. So within the first week of the crisis hitting, we utilized the resources that we had as a company to make groceries available. So we work with a lot of local businesses, local farmers, and we called on those relationships to create a series of products to make food available to our communities, which was something we did not only for Tender Greens. Obviously, we needed to stay in the game and drive revenue, but we also saw it as a great opportunity to find an outlet for many of the businesses we work with who suddenly had their channel shut down. So many of the farms and small businesses we work with actually support many restaurants in the country. So when all the restaurants shut down, a lot of those items, including fresh produce, had no place to go. So we created a series of grocery boxes to make those items available to our consumers at very reasonable prices. And it really gave us the opportunity to, again, drive some sales and help folks out. But it also helped Tender Greens stay relevant at a time when people weren't really sure if they wanted to be ordering takeout. We didn't ever close down permanently in most of our locations. We always made carry out or delivery available. And so once we moved out of the grocery business, we also looked at other areas where we could stay relevant. We created a family meal program which is a meal for four for under $50. And we also updated our loyalty program so that it would make the benefit of being a loyalty customer available immediately, providing 10% off to anybody who used the Tender Greens app to purchase food. So we've made a lot of changes to the business to try and keep up with what was going on and to continue to drive revenue for Tender Greens, but also to stay relevant at a time when a lot of things are changing.
And as a loyalty customer, I appreciate that program that you adopted.
We appreciate you.
Yeah, thank you. So one other follow-up on it. What are some recent techniques that Tender Greens has used to address the safety and health of its employees and customers?
Yeah, so I mean, anybody who's been a part of the restaurant community before this knows that the restaurant industry standards around cleanliness, maintenance, overall protocol is much higher than it is in any other industry. So going into this, our standards were already extremely high around safety and cleanliness. When news came out around the way that this virus could spread, we took all the additional precautions necessary to keep both of our guests as well as our team members safe. We wear masks in every single restaurant. We have little feet that indicate what safe 6-foot distance is between customers. We've put up plexiglass shields in front of our cashiers to avoid any contamination there. And we also, until we actually open our dining rooms, which we will be doing actually in 2 weeks. Right now we've opened our patios, but right now when a customer orders food, we will bring it to them or we will put it on a shelf so that they can grab it themselves to avoid the interaction between too many team members. But we've definitely gone above and beyond government guidelines. But as I mentioned, even going into this, and I think a lot of people in the restaurant industry already knew that restaurants were probably one of the safer places to be just because the requirements have always been extremely high around safety, cleanliness, and health protocol.
Yes, and I'm sure that your loyal customers appreciate that. I think the challenges for many of the restaurants is adopting those measures while other restaurants don't seem to be as sincere about the compliance factor in that regard. I bet you
Yeah,
that is a bit of a...
I'll just say also, I spent the last 2 days visiting all of our locations in San Diego, Orange County, and visiting, competitive restaurants in the areas. And there's definitely a wide breadth of how people are looking at some of these standards, but I think most are doing a great job, and I feel confident that Tender Greens is definitely leading the path in terms of what this next version of normal should look like.
Wonderful. We expect that will be continuing. Let me shift over to Duane at this time. Duane, when times were better, you were leading teams for capital raising and M&A deals for restaurants. What are you seeing as the level and pace of deal activity during COVID-19?
I'll get to that question, Joel, but one side note, I think Danielle undersold some of the creative things Tender Greens did. I've been a customer of theirs for a long time, and one thing they did that was really unique was when we ordered in, they delivered a roll of toilet paper. And as you can recall, the run on toilet paper, it's just one of those things, 30 years from now when I'm in my rocking chair telling my grandkids about COVID, I'll probably tell that, but tell that story. But in terms of the pace of deals, it's definitely picking up after a 3-month really complete shutdown with distressed and healthy companies. They have really started to pick up. We've closed 2 deals within the last 2 weeks and have 4 or 5 that we expect to close in the next 5 weeks. And in terms of just new prospects and pitch activity at our firm, it is extremely high, both with healthy and distressed opportunities, which is something I've never seen before.
Yes, and we'll get to more about the distressed opportunities during the discussion. Let me follow that up with another question. Many middle market capital raises were put on pause during COVID-19 until more positive information could be generated, from the gradual reopening of restaurants. What advice would you give restaurants as they try to reopen and to begin discussions about funding sources? Well,
I would say that capital is still there. It's It's obviously challenging, but when I say capital, I mean both debt and equity. I think the real advice I would give to restaurant operators is really put a lot of effort and work into defining and describing to investors what your new business model is, how you're going to react to this new environment that we're in. And that could entail simplifying the menu, closing unprofitable locations, increasing your takeout business. But for example, we have a client right now, it's about a 500 unit chain of restaurants, and they were running close to 40 million of EBITDA last year. Then it dropped to negative EBITDA in the first quarter. And the business plan that they're putting forth with a lot of detail behind it is getting to about $25 million of EBITDA. And that is the run rate that we will present to investors. Some of these investors are going to be debt, yet we're raising about $65 million for them. And our expectation is that about half of that will come in the form of debt and half of it will come in the form of equity. So yeah, capital's still out there. It's coming from unique places, but we're confident that we can still get it for our clients.
Yeah, the emphasis we're placing with our clients is to have a credible business plan as they gradually reopen and continue to operate during the COVID-19 environment. Very important for them, as you pointed out. It also will support, in some ways, their valuations. We've kept in mind to try to keep an accurate record of the different expenses and revenue changes that they've seen during COVID-19, which will also explain more their story and present better, I think, to support valuations. What are some deal terms that are becoming prominent, or you're seeing more dedication in negotiations during COVID-19 or because of COVID-19?
A lot of the things that we're used to in the past, when there were gaps between valuation between buyers and sellers, but things like earnouts, things like capital coming in, not all at once, but in tranches based on the company hitting predetermined metrics. We're seeing some transactions getting done with what I would call PE fund economics, where the new capital is coming in, the equity capital is coming in, and perhaps for the first, until they achieve 2 or 3x return on their investment, they're getting 75% in the waterfall. And once they hit 4 or 5x return on their capital, then that might flip to 25%, with the 75% going to existing ownership and management teams.
Yes, we too are seeing more in the earnout area, as well as some clawback situations that relate to performance metrics. I'd say that the deal terms are falling into kind of the 3 expected categories. You know, the M&A MAE condition, the covenant to conduct business in the interim period, as well as the reps and warranties. We're seeing a little longer due diligence or exclusivity periods. And I think the debate is about, you know, what is ordinary course of operations in COVID-19 or subsequent to COVID-19, and what will be permitted by the buyer and what the seller expects to occur. In reps and warranties, every buyer's draft seems to have in 60 to 70% of the representations, you know, some statement about COVID-19, and sometimes the seller's counsel will push back and say, let's try to narrow that into one representation, much the way we handle taxes or environmental law, so that there's no confusion about the impact. But a lot is going on in that area. And of course, indemnities come into play. Let's move on to Steve.
Joel,
Yes.
One other thing, a term that's really important, obviously, are the go-forward rents. And so at this level, it becomes a bit of a 3-party negotiation, buyer or investor, along with the seller and the landlords. And for example, I was talking with one group, and they're trying to negotiate with the landlords going forward that there will be a force majeure clause that will apply in the event that there's a future shutdown because of a recurrence of cases. So percentage rents, I think we all know that that's also a big push on negotiations with landlords, and it's become a deal term that is very important to the new capital's investment.
Thank you. Let's shift over to Steve now. Steve, we know your expertise is in the food and product supply chain and restructuring, and that's critical in these times. What advice would you give a restaurant owner about addressing its supply chain?
Well, first of all, I would have good communication with them. And I would let them know what your issues are, what your needs are, and also what you're doing to take care of the problems that you're having with your business. You're basically talking about your business plan. And that's very different than a lot of relationships were before this. And, but I think that restaurants need their suppliers for help. But they have to understand that the suppliers have gone through a similar type issue that they have. Many of them for a long time were at 30 or 40% of their previous business rate, but they had all of their expenses and they had to try to work around it. So that would be the most important thing I would do, I would say. And when you're talking about your plans with them, share with them all the things that you're doing to build up business, just like Danielle was doing. That the fact that you're doing it and they don't know about it is crazy, because that's going to really benefit your relationship. So just be open and honest with them, and they'll try to work with you. They're doing the same thing with their supplier base. They're all going to their supplier base for help. And
yeah, everyone is kind of in the same boat in that
really
respect.
are. When you think about it, they really are in the same boat. And also, one of the things that's going to happen from this, as a restaurant chain, you need to check out, some distributors are not going to make it because of the loss of business and of them being too highly leveraged. So there's going to be more mergers. There's going to be more that are going to just not be in business. And while they're going to do due diligence on you, you need to do due diligence and make sure you've got a solid person supplying you. Because supply chain to the restaurant industry is, it's really key to everything.
In connection with the due diligence you commented on, if some restaurant owner were coming to you today to seek your advice, what critical information do you need to start to render that advice?
Well, when I'm talking to a restaurant chain, the advice that they would hire me for was always issues that had to do with purchasing. In all of these projects that I told you about for these different restaurant chains, it was to help them improve their purchasing. And normally what I would be able to do with the different techniques is to maybe reduce purchases anywhere from 4 to 10%. And to them, that was very significant because it didn't require any investment of new facilities. So they'd get a real benefit from it. So that's
Thank you.
really what I would do.
We also are emphasizing to our clients, they've got to have, as others have said, credible business plans, but this is cash flow, projections, monthly, quarterly, and financial projections, and that credible business plan being critical. Let's shift gears now to Brian. Brian is a real well-known restructuring counsel. Restaurants and other businesses come to you, and their liabilities are staggering, and they don't see a way out. Share with us how a restaurant should deal with its bank and what the bank's rights typically are.
Thanks, Joel. There are a number of things that we need to know in dealing with our lender. Is our bank secured by collateral of the business, or is it unsecured? A secured lender has significantly greater rights than an unsecured lender. So that's going to be one factor that will feature into any discussion with your lender. It's important as to whether there's any personal guarantee. If there is a personal guarantee, then notwithstanding whatever happens of the company's repayment of the loan, there's personal liability. That obviously will also influence the discussion. Understanding the scope of that guarantee. Is the guarantee a full recourse guarantee? In other words, that the principal or the guarantor has full liability, whatever happens to repayment by the company? Or is it what's sometimes called a bad boy guarantee, where the guarantee is limited and you're only liable for certain specified acts, which might be, for example, if the company files bankruptcy. It's also important to understand who your lender is. Is your lender a regulated commercial bank? Is your lender a private party? Again, those will influence the conversations and the accommodations that the lender is able to make. There is, as a result of this COVID epidemic, a guidance that's been provided by the federal regulatory agencies that does allow regulated lenders the opportunity to give accommodations, deferrals to customers, borrowers who have been impacted by COVID-19. So that's something, to the extent that you're dealing with a regulated lender, you should be aware of. You should also be aware that even though you've been dealing with your friendly bank officer, when a loan does get into distress, very often it'll move over to what's called special assets. The special assets group of most of the regulated lenders is handled by someone who's very experienced in workouts, and they will be asking for a lot of financial and business information. And much like we've all been discussing in dealing with vendors, in dealing with other aspects of your business, you really need to approach your lender with a plan in place, with projections in place, financial projections, business projections. A really comprehensive business plan will infinitely aid your discussions with your lender.
And having good counsel to advise you, I think, will be helpful in that context also. Let me follow up on something that Duane mentioned in his initial comments, and that had to do with the landlord-restaurant relationship. Landlord leases are very important for restaurants, and their expense is a significant one on the balance sheet and P&L. So how should restaurants deal with their landlords, and what rights do landlords typically have?
Sorry, Joel, I was on mute for a moment.
If you can address the landlord-tenant.
Yeah, no, I
restaurant
got that.
Relationship and what rights the landlord has, as well as, the situation again with personal guarantees. Thanks.
Yeah, again, much like in dealing with your lender, you want to know who your landlord is. Are you dealing with the landlord, which is a national REIT that owns shopping centers around the country? Are you dealing with a mom and pop landlord who might just own the corner center? Again, those factors will influence the conversation that you're having with your landlord. It also depends upon where you're located. There are different jurisdictions throughout the country that have different rules regarding what it is that landlords can do to evict commercial tenants. As an example, in California, currently the California Superior Courts are not processing unlawful detainer summons. In California, if you're a landlord, you simply are unable at this point in time to evict a commercial tenant because the courts are not processing those procedures. So that obviously will influence the conversation that you're having with your landlord. There are a variety of different alternatives that are available in your conversations with the landlord. You could be discussing a full or partial rent abatement. You could be discussing rent deferral. You could be discussing what I'll call a blend and extend scenario, where in exchange for some accommodations now, you enter into a longer term lease. Maybe that's not appropriate, maybe it is appropriate under certain circumstances. You may be talking about providing the landlord certain credit enhancements, such as a guarantee or an additional deposit. Many restaurants are talking about percentage rent. And I know that that is a challenge for many restaurants, but that has become a focal point of many of the discussions. And in other cases, it may just be that the parties recognize that the restaurant can't make it, and there's an agreement to an early termination of the lease agreement. So there's a variety of alternatives that are available for these discussions.
Absolutely, and kind of evaluating those alternatives. Some of the advice I can give to clients is that you always have to consider, how your proposals would sound to a jury or to an arbitrator if unfortunately everything breaks down. So being reasonable and rational in the course of negotiations, I think is an important factor. Okay, let's go now back to Denyelle, who's actually dealt with the situations with landlords and lenders. And then Denyelle, if you can share with us how Tender Greens has managed its landlord and lender relationships during COVID-19.
Yeah, so the landlord conversation, I mean, we could spend a whole hour talking about this
Yes.
Particular topic, as it, I think, is one of the most complicated and time-consuming elements of managing around the COVID crisis. First and foremost, I think, something that Stephen said with regard to suppliers, and then also Brian alluded to it, I think from my perspective, in all scenarios, transparency is helpful. I believe that all people having the same amount or some equivalent amount of information can be very helpful to the conversation. So our approach immediately was to reach out to all of our landlords, and we have 27 unique landlords at Tender Greens, to just let them know what we were dealing with. And one of the things that's become obvious to me is that many people in the restaurant industry, specifically restaurateurs, CEOs, we make assumptions that landlords really understand the day-to-day operations of our business, and they don't. They understand their business, and they get a check in the mail once a month. But when this crisis hit, I don't think for many of them it was obvious the extent to which the business had crashed. I mean, for Tender Greens, this all sort of really hit us in a big way the second week of March, and our business dropped by 80%. So unlike landlords where we're not guaranteed a certain amount of money every single month, we had a reliance on traffic patterns that we were accustomed to, and suddenly that changed overnight. So I think for us, one component of it was to immediately go out to our landlords and just say, hey, just so you know, this is what we're experiencing right now. And we're going to need a minute to sort of figure out how to deal with it. So we tried to get as much information as possible together as quickly as possible to be able to share it, but that's also really hard in a dynamic situation where we don't know what's happening next. So again, we, along the way, we tried to share what was going on. About 2 months ago, we started working on a plan to go out to every single one of our landlords to say, look, historically, and again, we've been open book about this because my singular goal as CEO of Tender Greens is to keep the company in business, to stay afloat and to get the business back on track so that we can have a profitable business for the future. And there are a lot of things that go into that, but one of those things is creating a situation where I can let all of our business partner know that that is our primary goal. And that means there might be some temporary pain for all of us just to get there. So what we did was we created a packet that showed historically what the business has done. We showed individually to each landlord what the revenue for their location was. We showed them what percentage of business that was during peak times. We showed them what revenue looked like in February and March. we showed them what our business would look like if we continued to pay them the same flat rate we were paying them with the current, COVID revenue structure. We showed them a forecast of what that would look like for the business. And we basically painted the picture to say, like, if we continue paying everyone what we're paying today, we won't be around in a year and we won't be able to pay anybody anything. And we did that in a way that I think was very illustrative of what was going on without being threatening. Because I think, the landlord side of this is suddenly they're not receiving checks. They don't have a sense of necessarily how businesses are doing. I think there are some businesses that probably have taken advantage of the situation or who maybe weren't as transparent. And I think that could probably be very frustrating to a landlord as well. So we basically said, here's what's going on. Here's what we think is going to happen. Here's what we're asking for, which is, predominantly a percentage of rent after some period of either a deferral or complete abatement. We laid out the case and we said, this is what we think is going to happen. And in some cases, we offered to extend the lease, et cetera. But broadly speaking, if I had to boil it down, I would say we tried to find a way to make it work for everyone and to paint a picture so that they can see that this is going to be good for all of us in the long run. I mean, no landlord wants a dead client. No landlord wants a vacancy. Tender Greens, was a very solvent, strong company going into this. We had some units that weren't performing as well. We've been honest about that too. We've had some leases where we've said, hey, look, in the best economy in a very long time, we had some restaurants that weren't performing well. Can we maybe renegotiate this lease or get out of this lease? We also have some locations that, against all odds, were performing almost where they were before this happened. In those cases, we said, look, we're still going to pay you the majority of what we've paid you in the past, but, and I know you're not going to want to hear this, we need to spread the wealth a little bit because I need to keep afloat the entire company. So we've been willing to be transparent. We've been creative. We have taken the approach that we're all in this together and that we want to land in a place where all Tender Greens will still be surviving and even thriving in the future. And for the most part, I would say 85% of the landlords we've worked with have been very flexible, very willing to have conversations. And I think it's gone a long way to changing what has maybe historically been an adversarial relationship. And that's been very good. I will also say, which is a little bit of a secret amongst some of us in the restaurant industry right now, we are keeping a list. So I am on a call twice a week with several hundred other CEOs in the industry. We have a list of all national landlords across the country, and we're keeping a list of what these interactions are like with those landlords. Because at the end of the day, the economy will turn around. Many of us will be growing again. Many of us are going to be taking advantage of what we see as great opportunities from a real estate standpoint. And we're going to be looking at this list to see which landlords have been really willing to work with us. Because I can say, I've been in the retail restaurant industry, looking at sites for over 30 years now. And there have been times and conversations where I'm looking at a space and I'm interacting with somebody and I'm thinking, is this going to be a great long-term relationship? I mean, this is a 10-year relationship in most cases. Is this somebody that we're going to want to work with? And even though we've never experienced anything like what we've experienced in 2020, there are things that come along where you need to be able to negotiate and interact in a positive way with the landlord. Yes. And so I'm very confident that many of these landlords who are operating in good faith and being flexible and trying to find ways to work with tenants, that's going to be really good news for them when the economy turns around and we're all sharing these notes saying like, hey, this person was really helpful. They're willing to work with us. They're creative. We've extended leases. I mean, we've got national landlords that I'm already saying, hey, look, this is a rough time right now, but we're planning on expanding in these markets in the next 2 years. Let's talk about what your developments look like. And I think in the long run, those of us who are operating in good faith, who really want the best for everyone, will benefit from these conversations today in a way that none of us understand now. For the very small portion of landlords who are being inflexible, we know who they are. We're exchanging names and numbers of who those folks are. And when the economy turns around, we're not going to be going back to those locations. So I think this has been a very, very interesting time for restaurateurs to be able to navigate around this. And I think it'll shape the future of what real estate looks like in the restaurant and retail industry.
Thank you, Danielle, for sharing us your personal insights into the challenging relationship between restaurateurs and landlords, and also offering a model for other restaurants as well as to change the paradigm for that relationship. Thank you very much.
Thanks.
Steve, let me switch over to you for a moment. Obviously, restaurants are cash strapped and they've got issues with their vendors and creditors and pushing for collection. Can you tell us how you suggest dealing with situations like that?
I think you have to be open and honest with them and tell them what you're capable of doing and what you're not capable of doing, but just try to be fair with them. That's the very best you can do. And most of the distributors are having their own problems, but they're working with people. Now, what will happen with a lot of them, with individual restaurants, maybe they'll take what you owe them and they'll just put it in abeyance. But they'll be very concerned about having that amount of money increase. So don't be surprised that a lot of individual restaurants are put on a COD basis. I think chains will have more leverage, but individual restaurants will have that type of an issue going forward. I wanted to add something to what Danielle said about the landlords, if you don't mind. One of the things that I've seen in the last many years, that people who have invested in real estate, many of them, especially in the area that we're in Southern California, have overpaid for the real estate. And when they see a lease come up, then when it's going to be come up, then they want to double or triple or quadruple the rent that they're charging, and they make it unprofitable for restaurants to do it. I've seen this over and over again. Once a lease is up, the restaurant leaves, and then they go 3, 4, 5 years before they get somebody else in there to take the lease over. It's a crazy thing, and I think it's sort of adding to this. And I've got a feeling that this is going to affect what people go out and pay for real estate, because they're going to be worried about this occurring in the future. I could be wrong, but because I'm not a real estate expert, but that's my experience from watching what's happening in so many individual restaurants and small chains.
Yeah, an impact on the entire market. Thank you. Well, we've talked a little bit about what's occurring now. Let's look forward now to the future a bit with our speakers. Danielle, how is Tender Greens positioning itself with respect to third-party delivery services? What do you expect that's going to kind of bring balance to delivery service charges to restaurants and customers?
Well, we were pretty early adopters of third-party delivery, even before these crises came into play. We were already looking at ways to optimize our relationship with third-party delivery. And for the most part, the relationship between Tender Greens and DoorDash, Postmates, Caviar, all the folks out there has been very positive. We have negotiated terms with them where our delivery business is actually a profitable business. Unfortunately, it wasn't necessarily growing our business. Many of our guests were transitioning from being indoor dining or carry-out customers, so it wasn't completely incremental, but we were able to make some money around this. One thing that we started working on a year ago was a program called Dispatch through the company Olo that allows customers to purchase delivery through Tender Greens directly. So if you download our app or if you purchase Tender Greens online, you'll be purchasing through Tender Greens directly, where we pay less of a fee. But what I can say, and I don't know if every consumer realizes this, but when you purchase food from third-party delivery app, you're often paying more for it than you would if you went to the restaurant directly, because we do need to offset some of those charges. So we have continued to maintain a great relationship with our third-party delivery partners, but we have really doubled down on our own app and our own delivery so that we can get those goods out to folks at a lower price. And I think we'll continue to do that. But it'll continue to be a part of our business because I think people are getting accustomed to it. We've also seen a lot of people move to delivery that had never used it before. I know even in my own neighborhood, when we were offering groceries goods, I have, a lot of baby boomer neighbors who had never done delivery before. And so I helped them download the apps on their phone and help them understand it. And so I think when we go back to a more normalized dine-in versus delivery environment, we're going to see users of delivery that maybe we didn't have access to before, which I think overall will be very, very good for the restaurant business.
Excellent. Let's shift over now to Duane, because, restaurant owners are always thinking in the back of their minds, as are investors, about liquidity events. So, frequently the question is, what are investors looking at in assessing enterprise value now for restaurants? Will they be willing to look to pre-COVID value, revenue? Will they be only looking at the current COVID-19 environment, a combination? What's your impression?
Well, I think that they absolutely will have to look at pre-COVID performance. As the example I gave earlier about our recent client, their EBITDA has turned negative. So you can't apply EBITDA multiple to a negative EBITDA. So the past is often a predictor of the future. That being said, in my previous response, we also talked about how there might be significant changes to the business post-COVID, perhaps a smaller footprint, perhaps other changes to the business model, more delivery, which is less profitable, things like that. So I think another thing I don't want to understate in terms of assessing enterprise value, and this also applies pre-COVID, is management. That is what you're really investing in when you invest in a restaurant concept. And there has been, and I think will continue to be, a flight to quality. So what do I mean by quality? I believe there's 3 buckets that you could put that in, and it's the concept, scale, and the balance sheet. When you talk about concepts, I think those concepts that already had great momentum pre-COVID will continue to have good performance during COVID and get back to great performance after COVID. There certainly will be some segments in terms of concepts that are going to really struggle, perhaps go away, and those would be things like the buffet concepts, concepts that involve kids play are really going to struggle, I think, for some time. And then other concepts like QSR, I think we perhaps talked about that earlier, are going to do well because of the drive-through business. In terms of scale, it's as important as ever. I've heard, Joel, you mentioned earlier that 20% of restaurants may go away. I think that I've heard in terms of, there's fluctuations in that percentage. I've heard that an estimate of as much as 30% of the independent restaurants will go away. And the independents typically don't have the scale or the strong balance sheet by definition. Having scale, of course, there's always benefits to scale in terms of being able to leverage overhead over a broader base of units. But in this instance, I think scale is also typically going to allow those companies to invest more in perhaps things like digital or marketing that's going to help the company grow and survive during this downturn. Lastly, in terms of those strong balance sheets, there's going to be significant reopening costs. I've heard a lot of ranges from $100,000 to $200,000 per unit. So if you don't have a strong balance sheet, you're just not going to be able to do that. And those costs are for retraining, rehiring, advertising, curing past due rents, and they are going to just put a lot of businesses out of business if they don't have the capital to do that.
To supplement the point you made about the startup costs or reopening costs, there have been some adjustments in the federal government's PPP loan program to extend the use of those proceeds, as well as through earlier of 6 months or December 30th, as well as the amount of percentage that would be forgiven. So that's hopefully intended to help out restaurants, because the original program was a very challenging one for them. I note one other point about the enterprise values I emphasize to clients is what I call the COVID-19 EBITDA adjustments. Make sure that they're keeping accurate records of expenses and revenue adjustments, employees as suppliers, the supply chain and vendors, landlord costs, and so on, as well as even new revenue sources so that they can explain their story better. Let me shift over for a moment to Steve. Give a quick summary of what you see the food supply chain looking like, post-COVID-19, in light of COVID-19.
I think the biggest difference is going to be in smaller distributors, and also even some larger distributors who weren't well financed. I think what we're going to see is more mergers and more discussions, and I'm already having discussions with people along that line. So I think that's part of what's going to happen. It's a similar thing when you're discussing the restaurants, when I think Duane made the point that an individual restaurant won't necessarily have the balance sheet to get through this. A small distributor has that same issue. And so I think it's going to be a similar type thing. You're going to see more mergers and more sales of company, and some companies that are going to go out. I talked to a very, very big distributor group. I talked to him yesterday, and what he told me was very encouraging, actually. They have like 280 members across the country. And he said that the average member is between 80 and 90% of where they were pre-COVID. I was flabbergasted.
Surprised by that.
Flabbergasted. And I said, how many members have you lost? We lost one. And we think there might be one more. So that was extremely encouraging to me. I still haven't necessarily agreed that he's correct, but it was very encouraging news to hear. So that's
Thank you for sharing that. Great. Brian, let's shift over now, a little more discussion with you. We've talked about strategies for restaurants in addressing with landlords and lenders. We've talked about the strategies with respect to food suppliers and the food chain itself. So, problems do arise. There are often very staggering challenges. What if the restaurant's unable to come to terms with its vendors, landlords, or lenders? What are some legal alternatives that a restaurant owner has?
Well, this is obviously a topic that can take the whole day to go through, but very basically what we've been talking about to this point is essentially working with your individual vendors, creditors, suppliers, in essentially an out-of-court workout. That's essentially what we've been talking about. As we've been observing, that can be very difficult because each situation has its own challenges. Each landlord has its own unique things that it's looking for. And so sometimes that becomes impossible to actually accomplish an entire workout in an out-of-court scenario. And so there are alternatives available for restaurants in the form of a bankruptcy and or in the form of what I'll call an assignment for benefit of creditors. So there are basically, and this is just a very, very high overview, a 40,000 foot overview. There are basically two kinds of bankruptcies that are available. There are a Chapter 11 bankruptcy, which is principally for a business that is looking to reorganize and come out the back end as an operating entity, but in a different form. And there's a Chapter 7 liquidation, which is for businesses that haven't been able to make it. One of the real principal benefits, particularly for a restaurant operator or for multiple operations where you have multiple units, is that in a bankruptcy case, there are two principal benefits. One is you get the benefit of the automatic stay. The automatic stay is the stay that comes into effect to prevent any action being taken against the company upon the filing of a bankruptcy. So lawsuits stop, landlords stop, lenders stop. Everything has to stop pending approval of the bankruptcy court. And that gives the company a breathing spell in an effort to try to reorganize. But the other principal benefit to a restaurant operator is this ability to what's called assume or reject leases.
I'm having trouble connecting to the internet.
And so I'm sorry, I've got my Alexa going on over here. The ability to assume or reject leases means that when you are in a bankruptcy case, you have the ability to determine which leases are not profitable and to reject them, to get rid of them, and to take on those leases which are still profitable for you. And that for a restaurant chain can be a very, very significant benefit. Ultimately, the benefit of the objective of a Chapter 11 is to develop a plan of reorganization, which means that you need to work out an arrangement with your creditors. There's a particular protocol in how you get approval by your creditors. And then ultimately what you're looking for in the back end is this plan of reorganization, which is essentially a rewritten contract as to how you're going to pay your banker, your landlord, your vendors, and your other creditors.
Okay, thank you for the overview. Can you discuss briefly sales of businesses through the bankruptcy, in the bankruptcy context?
Sure. As many of us have probably heard, there's this concept called a 363 sale. It's so-called 363 because it's under Section 363 of the Bankruptcy Code. And what that permits is a sale, what's called free and clear of liens. And the principal benefit that a buyer sees in going through a 363 sale is that many buyers of distressed assets are concerned that if they buy the assets, that the liabilities of the seller company are going to come along with them, something called successor liability. And in order to preclude successor liability, buyers may require that if they are going to acquire the assets of the company, that they go through a process whereby they get protection from that successor liability. And one of the ways to do that is through this 363 sale process, which is essentially a sale, much like Duane's company Focal Point does, except that it goes through this bankruptcy court process. And with that, the buyer gets these benefits of certain protections that are available to a buyer of assets in a Chapter 11. It can be done relatively quickly, and it can be done relatively efficiently, and it can present a very viable alternative for the acquisition of a distressed restaurant operation.
Right. Those of us in the deal community understand that the 363 sale has very streamlined representations and warranties. So that is extensive negotiations in that context, which bears its own risks, of course. Let's shift for a moment. I've heard something about a streamlined business reorganization process now available. Can you tell us a little bit about that?
Yeah, very briefly, Joel. So in February of this year, before COVID, the bankruptcy law was changed to provide a more streamlined Chapter 11 process for smaller businesses. The Chapter 11 process that a restaurant would go through is frankly the same Chapter 11 process that Hertz just filed under. So it's a complicated process. And so there was an amendment to the statute called the Small Business Reorganization Act, which allowed companies pre-COVID to go through this more streamlined Chapter 11 process, provided that your debt did not exceed $2.7 million. With COVID and the CARES Act that provided for these PPP loans, that $2.7 million was modified and increased to $7.5 million. And so that can address the ills of many restaurant operations if they need recourse to a Chapter 11. And it provides, as I say, a much more streamlined process. Without getting into the details, there's no creditors committee. You're able to get a plan of reorganization approved without the consent of the creditors. Fundamentally, what you need to do is you need to commit to paying your creditors over a 3 to 5 year plan. And if you do so, again, this provides a very streamlined, less expensive process of reorganizing a restaurant operation.
Capital will still be critical, of course, for achieving that reorganization. Okay. Let's leave on a positive note before we go to questions and answers, because we do have several questions from our audiences. Can you each tell us a success story that's come out of this changing landscape? Let's start with Denyelle.
Well, I mean, I'll put it in two buckets. There's the during COVID success story and the post-COVID success story. The during COVID success story for us is really the conversation I led with around creating a product based on the availability of what our farmers and business partners had available. So we created a fresh farm box from Scarborough Farms. We worked with Bicycle Coffee LA and some of our other local small business partners to create groceries from around the city of LA, so we could help them get their products through distribution centers in a way that they weren't able to do before, et cetera. But in many cases, like our partnership with Larder Bakery, they were actually able to hire back most of their team as a result of these grocery boxes to help. We had about 5 or 6 different boxes. One of them was a morning box. And in several of our boxes, we had things available like sourdough bread and baguettes and other popular items. When we created these boxes and made them available, initially, after this company had reduced labor, like many of us, they were able to hire them back to help support these boxes. And so that was an example of us, I think, working together to help another business to be able to hire back people, which I think was great during the crisis. In terms of other successes, we launched, like I mentioned earlier, a family meal program, something that we had talked about years ago, never really got any traction. When we launched it, about a month and a half ago, we saw immediate success. We think more and more people are getting access to tender greens that didn't before this because of people starting to use delivery and maybe not using it before. But broadly speaking, what I would say is in this time, we have used this crisis as a sandbox to experiment and to try things maybe we wouldn't have done in the past. Because there was a lot of fear of change, and the restaurant industry isn't really rewarded for taking risks like other industries. And I've been part of, the various retail industries, including computers. I've been in the coffee business. I've been in the beauty business, and other businesses are really rewarded for taking chances or doing things. In the restaurant industry, the margins are thin. It's risky. We've really used this opportunity to test out and try things we wouldn't have done before, because why not? Right? We've tested products, we've tested programs, we've tested offerings. Right now we have for those of you who are local, we have an amazing classic cheeseburger available. We also have a chickpea patty version of it. The volumes at Tender Greens in the past would not have allowed us to make a cheeseburger. Cheeseburgers are actually very complicated, and they require a lot of fresh a la minute sort of creation. So we weren't able to do that before. With volumes lower, we were able to make a cheeseburger. So we're looking at taking this opportunity to A, do things we've never done before because we have the chance to do it. But B, I think people are just more forgiving right now. I think you can do something imperfectly and be rewarded for it in a way that you can take that learning and iterate on it and make it better in the future, but not have to get it exactly right the way you would have needed to do 6 months ago. So we've really used this crisis as an opportunity to be experimental. And I think, the more people that do that, the more people are going to have opportunities and things that they can pull from in their toolbox in the future when things turn around.
Right. I also might note that Tender Greens has sustained its culture for giving back to the community. If time permits, we'll let you talk about that, but that I know is an important element of Tender Greens. Let me shift over to Duane. What are your insights that we can take away from this COVID-19 that is to changes that may be positive?
Well, one of the success stories is, I think, one of the panelists here. Tender Greens is clearly going to be one of the stronger restaurant companies coming out of this. They have the strong balance sheet. They have the great management team. As you can tell, they have a great concept, and they've done things to, I believe, improve loyalty going forward. So that's one. But in terms of one that is near and dear to my heart because it's a client, we just closed a transaction, as I mentioned, a couple deals recently, but one in particular is a manufacturer of retail fixtures. And when this first hit and we were just going into the lockdown, and like everybody, every business out there, assessing our own first and looking at our existing portfolio of clients, thinking, okay, which of these deals is going to survive this pandemic and which ones are probably going to get pushed out to the future. And first thing I thought is retail store fixtures. Okay, this deal's definitely getting pushed out. And their customers, retailers are obviously under fire. Many of their stores are closed. Why would they be investing in new retail fixtures? But the reality is their business benefited. Their EBITDA was 18 million and the current run rate is 22 million. Why? Well, as you mentioned and Danielle mentioned earlier, they're investing in fixtures that have plexiglass to provide more protection from the spread of the virus. They also, their customer base was largely comprised of the cell phone retailers like AT&T and Verizon, and those were essential services, and those stores were able to remain open. So that would be a success story. We raised them $30 million, and we are now embarking on raising the second tranche of capital, which would be an additional $20 million.
Wonderful. I think that just so that we can move on to Q&A, I would just wrap this segment up apart by saying, I think what's impressed a lot of us as professionals is the resilience of our clients, how they have continued to find and prove themselves what's necessary in times of challenges. And we're proud at Greenberg Glusker to present a bulletin called In Good Company, which talks about our clients and friends as they've given back to the community to try to help out during the pandemic and how important that has been on so many levels. Well, let's move to questions and answers because we have several questions that have come in from the audience. Let me see how I can manage the process. Okay, one of our first question was what kind of liability protection do we have both from customers and employees with respect to the COVID-19 matters? And so the quick answer to that question is that, there could be the spread of the virus through a restaurant, primarily possibly because of the servers having to have contact with the customers, although efforts are made to contactless efforts, takeout and delivery. But the first question is cause and effect. Where was the virus caught? Was there some proof of element that it was caught at the restaurant? And the second one is a matter of that if an employee has contracted the virus, that the restaurant has taken reasonable steps to address that situation and to quarantine that employee. Has the restaurant acted reasonably in the context of the CDC regulations as well as city and county regulations? There is some talk from lawmakers about possible legislation that may reduce liabilities of businesses if customers contract the coronavirus while visiting the business or as guests, but that hasn't made its way yet through into law. Brian, the next question we have is should some of the PPP money be returned if a restaurant can't reopen this summer?
Well, when you fill out that PPP loan form, there are certain representations that need to be made. There is no representation, on the other hand, that says, I guarantee I'm going to remain in business. You do need to make representations that you need the money to operate. You need to make a representation that you're going to use the money for the permissible purposes. And as we know, this most recent change to the CARES Act allows you to use only 60% for payroll and 40% for rent and other permissible uses. It's also extended the period for you to bring that to your employees to 6 months after the loan or December 31, whichever is earlier. But if I have a situation with a client now where we are actually just applying for a PPP loan now, the company is actually conducting a going out of business sale. It will not be around in December 2020. So the way we're doing that is we have calculated what our permissible PPP loan is. We recognize that we will not ever be able to get to full employment again. So we are actually reserving from the aggregate PPP loan a sufficient amount so that with our reduced employee FTE headcount, we're able to pay some back to the government when the company goes out of business.
Interesting strategy. Interesting insights. Thank you. Let me see if I can summarize one of these questions because of our time limitations. There was a question, Duane, about the availability or your view of capital markets for secured debt, as well as capital sources for restaurants and how to kind of manage the different tiers, if I'm following the question correctly. Do you want to address that?
Sure, and I'll start with just talking about one of the first transactions I talked about right now, the 400 unit chain of restaurants that we're going out to raise about 60 to 65 million. Our expectation is about half of that will be through secured debt, and the balance will either be from a non-bank lender or mezz fund or equity investors through some type of structured equity investment. And so our goal is to maximize the secured debt and minimize the dilution from the remaining balance of the of the capital that we have to raise. So I think the short answer, and I've emphasized that because I just think a lot of people don't think it's available. There is capital available. It is primarily coming from non-bank lenders. They're less regulated. They're willing to be more flexible in terms of personal guarantees and amortization schedules. So even though their rates are higher, they also could be more flexible in picking the interest for some period of time. But in a lot of cases, they're going to be secured by assets. Hopefully that answers the question, Joel.
Yes, thank you. Denyelle, one final question, if we may. The question from the audience is the following. With respect to the use of menus, disposable menus, cleanable menus, what is your advice in light of the fact that, you know, the pandemic is still with us?
Yeah, it's a good question, and one I talked about with my team a lot yesterday when a handful of us were actually visiting locations. We're just getting rid of menus, actually. At Tender Greens, because it's not a sit-down service, in the past, you would walk up and there would be a paper menu available that you could read while you were in line. And then above the register area, we would have a menu, but sometimes it's a little late for somebody to make an order if they feel, rushed. So we had a long conversation yesterday, and what I think you'll see, we're working on the details now. You're going to see a lot more use of our windows. We're going to sort of take a page out of the department store book, which is my background actually. And so we're going to be utilizing our windows a lot more to display things like large menus. So unless, again, with this decision made yesterday, but I believe that we're just going to dispose of menus entirely.
Okay.
Cheap, because the other thing is like these paper menus, you're going to throw them away. Like, I've seen them around, like you're touching them, have other people, but it's kind of like, to make them cheap, you're going to be printing them at the restaurant. Ink could smear or things could fade, and you're sort of reliant on these sort of decentralization of something like that. And I think the quality alone makes it not necessarily worth it. If we can come up with a large oversized menu in the window, not only will that allow people to be able to see the menu before they walk in, but when the restaurant's closed, people will be able to see the food that's available. So that's the direction we're going.
Yes, and I go back to that saying about combining hygiene with hospitality and how your customer, what their expectations are. Well, speakers, our time has ended. I want to thank you very much for your insights and time. Thank you to all our participants for joining us today. We'll now end the webinar. Stay healthy.
Thanks, Bill.
So.
Thank you.
You.